Welcome to the X Project Podcast. This is a podcast of the X Project Substack. To subscribe, please go to thexproject.substack.com. Market rules to remember. Bob Farrell's legacy applied to today's market. Podcast number 33. Published February 11th, 2024. First, a note for podcast listeners. This article contains a number of important charts and graphs. If you are not driving, you may want to open the article to scroll through to the charts to view while you listen. Again, only if it is safe for you to do so. In this article, the X Project will answer these questions. Why this article now? Who is Bob Farrell? And what are the market rules to remember? What do rules number 1, number 2, number 4, number 5, number 7, and number 9 mean for today's market? What does the X Project guy have to say? And finally, as always, why should you care? A reminder for readers and listeners, nothing that the X Project writes or says should be considered investment advice or recommendations to buy or sell any securities or investment products. Everything written and said is for informational purposes only, and you should do your own research and due diligence. You should discuss with an investment advisor before making any investments or changes to your investments based on any information provided by the X Project. Section 1. Why this article now? Many Wall Street bulls were undoubtedly hungover this weekend after partying hard and celebrating the S&P 500's close of over 5,000 this past Friday. The consensus continues to be pretty bullish on several measures, including the popular CNN Business Fear and Greed Index, which is clocking in at 78. The index rose from extreme fear in October of last year. You'll notice in the chart above that extreme greed corresponds to the market making new highs, and extreme fear corresponds to the market making new lows. For the X Project, hearing the words new all-time highs, greed, or consensus all invoke the timeless market rules to remember memorialized by the legendary Bob Farrell. Section 2. Who is Bob Farrell and what are the market rules to remember? According to Wikipedia, quote, in 1955, Robert or Bob J. Farrell graduated from Columbia University with a master's in investment finance, where his teachers included Benjamin Graham. After 2 years of service in the U.S. Army, Farrell joined Merrill Lynch in 1957. By 1967, he was made Chief Market Analyst, or CMA, at Merrill, a title he held for over 25 years until stepping down in 1992, then aged 60. For the 16 of his last 17 years as CMA at Merrill Lynch, Institutional Investor voted Farrell as America's best analyst in forecasting equity market direction, and he was inducted into the Hall of Fame. Farrell is considered a pioneer of technical analysis, and he is noted as being the first to incorporate sentiment analysis into financial forecasting. In 1970, he was made the first president of what became the CMT Association. After stepping down as CMA, Farrell stayed with Merrill as a senior investment officer, writing regular reports for clients. In September 1998, as the dot-com bubble was nearing its peak, Farrell published a list of 10 market rules to remember on the back of one of his reports. Rule number 1. Markets tend to return to the mean over time. Rule number 2. Excesses in one direction will lead to an opposite excess in the other direction. Rule number 3. There are no new eras. Excesses are never permanent. Rule number 4. Exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. Rule number 5. The public buys the most at the top and the least at the bottom. Rule number 6. Fear and greed are stronger than long-term resolve. Rule number 7. Markets are strongest when they are broad and weakest when they narrow to a handful of blue chip names. Rule number 8. Bear markets have 3 stages: sharp down, reflexive rebound, and a drawn-out fundamental downtrend. Rule number 9. When all the experts and forecasts agree, something else is going to happen. Rule number 10. Bull markets are more fun than bear markets. The rules received little attention when they were first published, and Farrell retired fully in 2002 after 45 years with the firm. Merrill Lynch chief North American economist David Rosenberg republished the rules in 2003 after the dot-com bubble burst, and they have been quoted by financial advisors ever since. Section 3. What does rule number 1 mean for today's market? Markets tend to return to the mean over time. The concept of mean reversion is not new. The earliest statistical version of the concept dates back to the 18th century with Sir Francis Galton and his work Regression Towards Mediocrity in Hereditary Stature. The relationship between mean reversion and investing is not a new idea either. Benjamin Graham highlights the link between the two in his book, The Intelligent Investor, as far back as 1949. What is the definition of reversion to the mean? Reversion to the mean, also called regression to the mean, is the statistical phenomenon stating that the greater the deviation of a random variate from its mean, the greater the probability that the next measured variate will deviate less far. In other words, an extreme event will likely be followed by a less extreme one. In the investing world, mean reversion is a financial theory that suggests asset prices will eventually return to their long-term mean or average. This concept is grounded in the belief that asset prices and historical returns will gravitate toward a long-term average over time. The greater the deviation from this mean, the higher the probability that the asset's price will move closer to it in the future. Moving averages are commonly used to measure a mean in equity prices. There is no one correct moving average to use. If you are so inclined, you can play with different moving averages, 5, 10, 20, 50, 100, etc. on daily, weekly, monthly, quarterly, or yearly charts, and you will get different perspectives using different means. Here is a long-term weekly chart from Bank of America Global Research of the S&P 500 using the 200-week moving average to show and explain the concept of mean reversion. Cyclical bear markets within secular bull markets tend to mean revert toward the rising 200-week moving average on the S&P 500, a key 2022 support near 3,500. This mean reversion to the rising 200-week moving average happened during recessions, economic slowdowns, and crashes during the 1950 to 1966, 1980 to 2000, and 2013 to present secular bull markets. These cyclical bear markets found support prior to continuing the longer-term secular bull market. Sticking with the 200-week moving average, here is an updated chart through Friday's close. Notice that over the past 10 years, the market price came down to the 200-week moving average 4 times, with the longest stretch between February 1st, 2016 and December 24th, 2018 being 151 weeks. With the 200-week moving average at 4,066.92 and the S&P 500 closing at 5,026.61, a reversion to the 200-week moving average at this point would be a 19.1% decline, and it has been 72 weeks since the last time the market traded at the 200-week moving average during the week of September 26, 2022. Bob Farrell's rule number 1 tells us there is a tendency for the markets to return to their mean. It is like a gravitational pull. The rule tells us nothing about timing as to when. Another way to think of this rule is that the market prices stretching away from their mean is like a rubber band. The further from the mean the market goes, the further the rubber band is stretched. You'll notice in both charts above that when the market reverts to the mean, the rubber band snaps back much more quickly than it was stretched away. Section 4. What does rule number 2 mean for today's market? Excesses in one direction will lead to an opposite excess in the other direction. Another way to think of this rule is the Eiffel Tower chart pattern, and here are 4 examples of the NASDAQ 100 from 1996 to 2003, crude oil from 2007 to 2010, cotton from 2008 to 2011, and the Dow Jones Home Construction from 2000 to 2009. However, note that rule number 2 doesn't indicate which direction the initial excessive price action is moving. The Eiffel Tower pattern is specific to the initial excess in prices going higher. Market crashes that form a V shape are examples of initial excessive price action going lower. Looking at the S&P 500 chart again, we can see the COVID-19 market crash as a downside example, and a smaller example at the end of 2018 and beginning of 2019. So probably a better way to think of rule number 2 is sharp rallies often lead to equally sharp corrections, and sudden crashes or sharp sell-offs often lead to equally sudden and sharp rebounds. Section 5. What does rule number 4 mean for today's market? Exponential, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. In today's market, the best example of an exponential, rapidly rising market is the price of NVIDIA. And here is a 10-year weekly chart with the 200-week moving average. Rule number 4 is similar and related to rule number 2. Excesses in one direction will lead to opposite excesses in the other direction. And as noted in the chart above, NVIDIA already showed us it can follow Bob Farrell's rule number 2 with an Eiffel Tower pattern. NVIDIA broke out to new highs of $163 during the week of May 24th, 2020. Its price more than doubled in 6 months to a high of $346 during the week of November 22nd, 2020. But then another 6 months later, it had given back all of those gains when it fell back to $156 during the week of May 9th, 2021. The difference between rule number 2 and rule number 4 is the warning in the latter. The price gains since the beginning of 2024 and even the beginning of 2023 are even more excessive or should we say using rule number 4 terminology, that NVIDIA prices have experienced exponential, rapidly rising prices. If we were only focused on rule number 2, we might only ask the question, are we seeing the left side of the Eiffel Tower starting from the 500 price level at the beginning of this year, or the $200 price level at the beginning of last year? And if we considered rule number 1 and observe how far from the mean as measured by the 200-week moving average, we might be tempted to think the top must be imminent and maybe the current price is a good price to sell short NVIDIA. Rule number 4 is a warning that the price, quote, usually goes farther than you think, end quote. And for NVIDIA, that might mean it goes to 1,000 or even much higher yet in the weeks ahead. Section 6. What does rule number 5 mean for today's market? The public buys the most at the top and the least at the bottom. Headlines are currently breaking news that Jeff Bezos, founder of Amazon, sold $2 billion worth of his Amazon stock last week as his SEC filing became public. He previously sold about $20 billion combined in 2020 and 2021. The tracking of corporate insiders' activity is an indirect way to follow rule number 5, since there isn't an easy way to track the overall public's investment activities. But Jeff Bezos is only one person who happens to be within close reach to being the richest person alive, and his actions might not have anything to do with whether or not he thinks Amazon's stock price is overvalued or not. What about all insiders collectively? This chart below was seen on several Twitter feeds over the past couple of weeks. Insider transactions ratio. While it indicates the ratio is back to neutral and bordering on bullish, it had a huge spike in January, indicating a relatively large amount of insider selling, which is considered bearish. And since the market was making or approaching new highs in January, depending on which index, it appears that rule number 5 might be coming into play. Furthermore, it appears as if this chart does not include Jeff Bezos' recent sale. Digging a little deeper into insiders' activity, here is a chart from OpenInsider.com that shows a longer history. I have noted the 4 largest sales with red numbers and the 4 largest purchases with green numbers. Let's see how those compare on the S&P 500 chart. What we can see here is that only the first of the 4 sales was predictive of a market top, and that was several months early. More significantly, 3 of the 4 purchases were good predictors of immediate bottoms, and even the first one was only a few months early, with the price declining a little bit more before a major bottom. So, insider activity can provide some predictive information some of the times. Another way to think about rule number 5 is from an individual investor sentiment perspective, on the assumption that if individual investors are feeling bullish, that they then proceed to buy, and likewise, if they are feeling bearish, that they then proceed to sell. The American Association of Individual Investors, AAII.com, collects and publishes this data. The sentiment survey measures the percentage of individual investors who are bullish, bearish, and neutral on the stock market short term. Individuals are polled from the AAII website on a weekly basis. Only 1 vote per member is accepted in each weekly voting period. The Visual Capitalist put together this great chart. And this chart proves Bob Farrell's rule number 5, in that individual investors are bullish at market tops and bearish at market bottoms. Section 7. What does rule number 7 mean for today's market? Markets are strongest when they are broad and weakest when they narrow to a handful of blue chip names. Unless you live in a cave without any internet connectivity, in which case you would not be reading this, you have no doubt heard of the Magnificent Seven and the concentration of those 7 stocks: NVIDIA, Meta, Amazon, Microsoft, Alphabet/Google, Apple, and Tesla. At the end of 2023, these 7 stocks accounted for 28% of the S&P 500 index, which is a weighted index by market capitalization. This means that the rest of the market outside of these 7 stocks is not nearly as strong. Here is a chart showing the S&P 500 returns are not much without the Magnificent Seven. The concentration of the Mag 7 is greater than the concentration seen during the dot-com bubble of the early 2000s and the Nifty 50 of the early 1970s. Here's an interesting chart that shows the subsequent S&P 500 price declines of 50% and 49% following those prior episodes of market concentration. There are a number of market breadth indicators, including percent or number of stocks above a given moving average, percent number of stocks above relative strength, periodic high-low, advanced decline, net new high, and net new lows. You could look up these on your own if so inclined, but I am running out of space and time for this article. Section 8. What does rule number 9 mean for today's market? When all the experts and forecasts agree, something else is going to happen. This is perhaps my favorite rule that I quote most often and feeds my contrarian soul. However, this one is very difficult to quantify. Who is an expert? How many are there? Who pulls them and aggregates their forecast? Here is CNBC's attempt, and it is arguably a very small sample. And even with these forecasts, it is their estimate of where the S&P 500 will be at the end of 2024, which doesn't tell us anything about the path from here to there over the course of the year and whether it will be a smooth ride or one with stomach-turning volatility. Section 9. What does the X Project Guy have to say? First, I want to thank all subscribers, mostly free and some paid, who have signed up thus far. Gaining additional subscribers every day at this point is a strong vote of confidence that continues to propel the X Project forward. Substack tells me that nearly 2/3 of you have 4-star or 5-star activity ratings, meaning you are consistently engaging with my content, which is great. Please hit the heart icon, indicating you like the article. The more likes I get, the more Substack will promote my content within the Substack community. If you don't like my content or have any suggestions, please email me at thexprojectguy@gmail.com. Second, I apologize for the late publication. Normally I publish early mornings on Wednesdays and Sundays. For today, I originally started writing another article on some non-consensus views as to why the stock market may continue rising and why the economy may avoid a recession. However, with the market closing at new all-time highs on Friday, my contrarian soul pulled me in another direction. I will likely publish the original article I started soon. Third, let me remind readers that have been with me a while, or inform newer readers, that my perspective is that of a 53, soon to be 54-year-old Gen Xer. In order to support my lifestyle for me and my family for the rest of my life, I need to continue to grow my assets by continuing to earn an income in excess of my expenses so I can add to my base of assets. However, I have accumulated a substantial base of assets already, such that one of my highest priorities is to protect and not lose the assets I already have. That does not mean sticking my money under a pillow or in a big bank savings account earning little to no interest, since inflation will continue to diminish the purchasing power of my money over time. Therefore, I need to protect my money by investing it prudently in assets that I can expect to provide a rate of return that will, at a minimum, keep up with inflation and ideally outperform it. The X Project exists to help me and others like me do just that, and Bob Farrell's rules to remember are important to help avoid losses when time is becoming the asset of greatest value due to its limited supply. To highlight this last point, I'm going to share one last chart showing the inflation-adjusted S&P 500 and the amount of time required to recapture losses. Staying invested on the precipice of a bubble can lead to long-term losses. Avoid the misconception that always staying invested is the best strategy. This inflation-adjusted chart of the S&P 500 from 1906 to 2022 shows a 116-year history where the market spent 91 years, or 78% of the time, just getting back to even. In the next section, I'm going to explain why you should care and, more importantly, what you can do about it. However, the X Project now requires you to be a paid subscriber to view the final section. In a few articles, the paywall will move up within the article so that only paid subscribers will see the last 2 sections, or rather, free subscribers will only see the first 8 sections. I will be moving the paywall up every few weeks, so ultimately free subscribers will only see the first 4 or 5 sections of each article. So please, consider a paid subscription. All paid subscriptions come with a free 14-day trial, and you can cancel at any time. Every month, for the cost of just 2 cups of coffee, the X Project will deliver 2 articles per week, helping you know in 1 to 2 hours of your time per month what you need to know about our changing world at the intersection of commodities, demographics, economics, energy, geopolitics, government debt and deficits, interest rates, markets, and money. You can also earn free paid subscription months by referring your friends. If your referrals sign up for a free subscription, you get 1 month of free paid subscription for one referral, 6 months of free paid subscription for 3 referrals, and 12 months of free paid subscription for just 5 referrals. So please, refer your friends. Thank you. This concludes the X Projects podcast number 33. Again, please subscribe to the X Projects Substack at thexproject.substack.com.